So I was gonna ask you that during the show, but I'll just ask you now. If he does hike, obviously knee jerk would be to sell, but to me, thinking through it, like that gives the Fed some credibility here, I think, and
Yeah.
that might give people, that might give people more confidence in knowing that his next move could actually be a cut if he got it wrong. Um,
It's not a bad thought. I mean, on the I guess it depends on what asset class you're talking about. We've been seeing a bid in home builders as if they think the long end is going to go down. So a hike would bring the probably long end down, as you said, to add credibility. So there
yep,
might be a bid there. We have seen SOFR sell off. So SOFR SOFR's already built in a 25 basis point hike. So, it could rally or stabilize.
priced in. Yep.
I'm not sure about equities because there's a whole lot of short-term financing that would be stressed, if
Yeah,
you will.
for sure.
Uh,
That's a good point.
so, and our obviously our treasury debt would go up in terms of financing costs, but maybe it gives them, if the long end rallies, it gives them a chance to roll it out.
Yeah.
It depends on the asset class. Is going to be my answer, but we can
Okay.
talk
We can
about
dig
this.
in.
Yeah. And then I just saw Sherman Williams was up big time. I'm not sure why. Um,
People buying paint.
well, that's what I'm wondering is, if you're going to stay, if I was going to play housing, it would be, those ancillary plays that
Home
are,
Depot, Sherman Williams, all the
yeah,
fixer upper guys. Yeah.
exactly.
Lowe's.
But, some of these home builders have done pretty well recently. Um, so, should we get started and then
Yeah,
Jeff
let's
can,
get started. You and I can go. All
yeah.
right, we're gonna let's get started, everybody. We're waiting on Jeff. Sorry, we're late. Welcome to Wall Street Beats. I'm Steve Lamar. I've got our banking and financials pro here, Charlie Peabody, and we're gonna talk. We're gonna talk some financials and banking stocks, maybe some housing stocks. It sounds like. Charlie, I would not want to be an investor in Kospi. I mean, that is just not for the faint of heart. Did you see that overnight?
Well, I'm short the Kospi through
Uh,
EWY. I mentioned that on the show a while ago, but yeah.
Good for
So
you. Well, not for the faint of heart. That one. I think that. How many times this year has that been limit down, circuit breakers on, going? I mean, at least a dozen times, maybe more.
yeah, and it was down 8% literally right away overnight, and then so they halted it, and then it ended up down 10 and change percent.
Oh, yeah.
Mm.
Okay. So is there still more to go there? You're sticking with your short?
I think it's a 2-year Eiffel Tower type of
Oh,
formation where it's
wow.
going to go all the way back to where it started from.
Wow. Okay.
So, but
Yikes.
there's going to be a lot of volatility around that 2-year process. So
Yeah, I would imagine. All right, I saw some decent numbers out of Coke this morning. That thing's ripping. So people are rushing. Looks like people are rushing into Staples. I saw UPS kicked Amazon to the curb, and their numbers look pretty good. And what else did I saw? So I saw Mercedes. Shitty guidance. People aren't buying expensive cars as much last quarter. Anyway, what did you want to talk about?
yeah, utilities are also getting a bid. So there's a defensive. I mean, healthcare has done really well. Utilities are getting a bid. I've mentioned in the past that things like Duke or AEP or PPL, PPL, SO, Southern Company. So they intrigue me, as do obviously the REITs like Essex Properties and Avalon Bay. And I still plug away at Flagstar, although it sold off after their earnings because they lowered guidance, which to me I think was irrelevant. We knew that was going to happen. But anyway, so let's talk a little bit about banks, and I want to come at it from two perspectives. One, what the FOMC meeting on Wednesday how that could impact regional banks. And then the other was I heard on the street column in the Wall Street Journal yesterday morning about regional banks. And the journal article was basically saying, here's a cheap way of playing capital markets. In other words, all these regional banks have been building up capital markets activities, very similar to what the big banks do, but they target small and middle market businesses. And it's becoming an increasing part of their revenue stream, and yet the regional banks, don't trade at 3 or 4 times tangible book. They do trade expensively at 2 times tangible book or more. So they're not cheap, but by my stretch of the imagination, but cheaper than a Goldman Sachs or a Morgan Stanley. So it was sort of favorable to the regional banks. So let me sort of throw out a couple of caveats as to why I'm not sure you want to chase the regional banks or the KRE regional bank index here. Jen, if you can put up the first chart. So on Wednesday, we have, the FOMC meeting. I personally am not a believer that they will hike on Wednesday, but I will tell you, this is the most uncertainty we've had going into a FOMC meeting that I can remember, certainly through the Powell days as the chairman of the Fed. Normally we have 95, 99%, probability of either a hike or a pause or a cut. Now it's 1/3, 2/3, 1/3 hike, 2/3 no, pause. So there's a tremendous amount of uncertainty. There is going to be a press conference on Wednesday, which Warsh will speak, but he has made it very clear he's not going to provide any forward guidance. So I really think what's going to be the key to this meeting is the amount of dissent. And we already know that Lori Logan and Beth Hammock and Kashkari have sort of leaned towards wanting to hike. But we don't know, how the whole thing is going to shake out, whether they want to support the chairman or show, dissent. But my feeling is if they do not hike, and again, I'm not sure I have any value added as to whether they're going to or not, but if they do not hike, and there is at least 3 or more dissenting votes, then the whole market is going to anticipate a hike in September. Because we know that October is off the board because of the election. So they either do it, Wednesday or in September, and the market's going to anticipate that. So short rates have been, if you look at SOFR, short rates have been rising. And the question is, how is that going to impact bank margins? So the salmon colored columns that you see there are, the left one is what banks are paying for their deposits, and the right one is the change quarter over quarter and the cost of those deposits. And the thing that I would point out is that the average cost of deposits that banks are paying on your deposits is 2.11%. So if they raise the Fed funds rate or market rates start going up towards 4%, there's probably going to be a yield-seeking behavior that develops again that hasn't been present for the last year plus. And that means there's going to be competition for deposits. And so the banks are going to have to start paying up to keep those deposits or grow those deposits. And that hasn't been an issue so far. Looking further out, there is also the Clarity Act, which I do not believe will be voted on before the August recess. But the Clarity Act would also create new constituents vying for those deposits. So this you want to watch what's happening to the cost of deposits in this regional bank industry, because if it does start to compress margins, then a lot of estimates are going to have to be lowered. So that's one takeaway of how banks could trade coming out of the FOMC meeting if the Fed develops a hawkish tone, either in an action on Wednesday or looking out towards September.
So Charlie, on the other side of that, would like a Charles Schwab be a beneficiary of that, or is there a winner to this loser?
Well, that gets into the next question, Steve, and that is, what happens to the capital markets if you start to hike rates? If the capital markets behave, then Charles Schwab absolutely would be a beneficiary. And you saw that in their recent quarter of reports. I think they had a very healthy flow of assets and appreciation in existing assets. So and transaction volumes at all of these brokers have been very, very strong.
Huge. Yeah.
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 So, um, a lot depends on how the capital markets react to a hike, which gets to the next slide. If I can do that, we can then come back and talk about, anything you want to. So this slide sort of addresses what the Wall Street Journal article was saying, and it shows how much on the left-hand salmon colored column shows how much of total revenues are generated from capital markets activities. And here I define capital markets activities as wealth management, because as assets appreciate, the fees you earn off of that grow. Trading, because of transaction volumes, and then investment banking. So those are the three major inputs to what I call capital markets revenues. And I show that as a percentage of total revenues. And you can see that Wells Fargo is at the very top, and they've been very aggressive since their asset cap was removed in building out their capital markets activities. And trading revenues are up, fold. At the bottom is the one bank I still have on my buy list, and that's M&T Bank, one of the most conservative Warren Buffett type banks. And they have a relatively muted but growing aspect in capital markets. On the very right-hand salmon-colored column is the year-over-year change in the capital markets revenues, which are in those white columns in the middle. And you can see, we've had, almost 20% year-over-year growth in capital markets revenues. Some of my bigger banks are looking at 40, to 80% growth in capital markets activities. So that, as I mentioned in previous commentary, has been the source of the beat and raise quarter that we just had. So now the question becomes, if we start to see a hawkish development in rate structures, what does that do to capital markets activities? My position has been that it's going to cause a dramatic slowdown in such activities. And therefore, you'll start to see less confidence amongst CEOs in the willingness to either pursue M&A or IPO activity. And those are the two product areas where you've seen dramatic, 100%, 80% growth year over year. So when I look at this slide and take it in conjunction with what's going on in the rate side, PNC stands out as a bank that I'm not sure I want to hold going into this period. They have the lowest rates paid on deposits, and they have a fairly large and fast-growing capital markets, capability housed in M&A, and it's all middle market, by the way, middle market M&A. The name that I'm comfortable with is U.S. Bancorp, although they just bought BTIG, which is going to add another 200 million to their capital markets activities per quarter. And it's largely equity related, so there is some vulnerability there, but I still like the diversification of their franchise. The other name I like is M&T, very conservative bank. The one name that I've liked in the past and no longer have on my buy list, recently took it off, is Citizens Financial, CFG. And I just mentioned they are sort of a binary story. They are a great play on a run hot economy and a strong capital markets. Their NIM has been expanding. Their private bank has been growing rapidly, and because they bought up all the old First Republic, pods. And their capital markets, because they're tied in with private equity and private credit, has been very robust. So if you believe that capital markets are not going to be disrupted by higher rates, that's the play that has a lot of leverage to it. So why don't I end my comments there and let's see if there's anything to talk about.
So Charlie, if I like to go back to the hike or not tomorrow, and if we get one or we get some visibility that it's coming in September, and maybe this is a question for Jeff too, that sounds like that would have that could have some real negative effects on the U.S. equity markets. The U.S. equity markets have really been kind of the underbelly of a strong consumer. And if that starts to fade, does the consumer finally start to fade with it?
I
Jeff, you
mean,
want to?
treating the stocks that way is almost a tradition.
Yep.
September is traditionally just a terrible month for consumer discretionary, down about 4% usually. And then you get the really predictable back to school is pretty strong. That usually means a good Halloween, which generally means a good Christmas cycle. And, lather, rinse, repeat. The question really, and I guess this is for Charlie as well, is it's they just announced new tariff programs the other day. It's they're almost kind of fighting to make things more expensive in one way or another, whether it's rates or just making the cost go higher or jamming oil up for kind of pointless war efforts. It's these stocks have been through quite a bit. I'm looking at my sheets today. I mean, Target's up 3.5%. That's making a new 52-week high. You have a huge bifurcation going on, and I'm not sure, you never want to call the consumer sort of, like that they're kind of hike proof. But yeah, the book does not tell you to get long a bunch of discretionary stuff in the face of rate hikes. That is absolutely not, in fact, what you're supposed to do. But we've become a little bit inured. I mean, you see it from the airlines, you see it from really anyone who's consumer facing. You can develop all the theories you want, but the consumer's still spending. It's the cruise lines reported today the algos take it down 5% because they noticed some weakness on the international front. Now that turns out to be cruises that go through literally Gaza. No kidding. I don't think that's out of nowhere. I don't think that's
Right.
that was probably pretty well priced in, and is not in fact reflective of anything other than there's actual missiles over our head. Those crews are less popular, but the ones
Yeah.
where you get the norovirus, man, you can't keep people off them. And the stocks, there's a huge dispersion among the stocks, and so I'm just kind of looking to pick up values. Amazon's going to be a great one for that, because everyone's just going to be looking at AWS and whether that can exceed 31% and how much they're going to spend.
Yeah.
I wrote a column today where just be a retailer, baby. Just be a retailer. You're growing your retail business at 13%, and you're the second biggest store on earth. That's a nice story. That gives me a lot more comfort in terms of you going bat crazy on your capex. It's a lower margin business, but I can make a nice little model for what you're going to earn. And I'm really impressed with that growth rate. And also says good things about Walmart, a stock that looks like it's breaking down. But how low does that really go without you taking the consumer hypothetical from we're in a recession to it's someday this is going to end, and so you can't buy Walmart ever because eventually the consumer will run out of money. All that's well and good, but Sherwin-Williams just beat and took up numbers, and they're just not that good at companies. They didn't figure out a new way to sell paint. That's demand.
Yep.
The one thing I would add from the banking perspective, and Jeff and I talked about this last week, is the banks, have just reported earnings, and they all talked about how resilient the consumer is, and the credit metrics show the consumer being still in a healthy shape. And credit card volumes are still growing at 5 to 7%. So all of those metrics look good. What I would point out is interesting on the calls. If you listen to Truist calls, TFC, or M&T, MTV, or CFG, Citizens Financial, they all have some niche businesses in marine and auto and RVs and motorcycles and education, and they are actually starting to run those portfolios down, which means they're a little bit nervous about the things that need to be financed by the belly of the curve, that 2 to 5 year part of the curve. So they're acting cautiously in the face of what are pretty good numbers. And then as far as the high end, Jeff knows this better than I do. If we do get a correction in this market, and it's not a V shaped like we had during COVID, where it comes right back, then you're going to have a negative wealth effect at the high end, and those cruises are going to be affected at that point. But it has to be a correction that stays down for more than a month or so.
And so far we've managed to take the air out of Bitcoin without blowing up the consumer. We managed to take the air out of a lot of these chip stocks. They're going through their own little tech correction. it's only feels like a little correction if you're not actually long the stocks. I'm sure the people that are long and watching them go down 20-25% feel a little grumpier about it than the rest of us. It's, to me, the market seems super sane because Target's up 3.5%, and boy, that makes sense. IMAX is doing well. It's any portfolio that's good for me, it assuages a lot of my other concerns for the country, I guess. But it's, I think you're right, Charlie. I think a lot of this spending is done just because of the wealth inflator that we've had, but that's also a reason the government is gonna, a very activist presidential branch is going to do what they can in terms of at least offsetting some of the unpleasantries the Fed might have to say, including
Yeah.
threatening the Fed chair himself.
Trump
They're
was
not beyond
insisting on
that.
rate cuts, Charlie. Come on.
Jeff is smack right on. Yesterday the market's right on knife's edge, where if it starts to break here, you're going to get systematic selling by the CTAs and possibly other players, fast money players. But yesterday, I think it was around 1:15, 1:30, Trump on board Air Force One, started talking about a truce with Iran and how the peace talks were going well. So here's a guy who is very tied into the markets in terms of where they are and what they're doing. And that invisible hand always seems to come out and grab the markets and support it when we're right on nice edge. So I don't disagree with Jeff that you just don't want to anticipate, some sort of market correction until it happens.
Yeah, he knows how to work the algos. That's for sure.
Yeah.
Just as the
So,
founding
Jeff,
fathers intended.
exactly.
But,
Jeff, did you see the UPS print? Any thoughts on
I
that?
did.
Yeah, I think
Kind of
that
a
supports
nothing
your.
to see here, but it's again, they're not good enough to outmanage a bad economy. They've proven that for years.
Yeah.
Is this the great UPS turn? I have other ways to play that. They're staying alive again. Companies that would take the pipe and a lot, and you can find plenty of exceptions to this, but a lot of Sherwin-Williams, as I said, they didn't design a new way to sell paint. UPS is much less innovative than it should be. It's much more of just a reflection of what's GDP going to look like, and they said that they were fine. The airline, they haven't seen any demand go down. There's just there's some smoke, but there's absolutely no fire in terms of consumer, and that means that these stocks that have been beaten up a little bit, you could see a little mojo in them. You could see a little pent up demand.
Going
Charlie,
back to your
I cut
original
you off.
question, Steve, about this market, and right now the weakness obviously is very visible in the tech space. Chips, memories, the hyperscalers, Mag 7. And so the rotation has been into things like financials, and they've held up very, very well. If this rate hike does create a deposit not run, but competition for deposits and competition for rates being paid for your money, then I think the financials start to come unglued, and then we start to lose another leg, because I think after tech, financials are the second biggest weighting in the S&P 500.
Yep.
So I think it's important to watch financials to see how resilient they remain in the face of rate hikes.
And some of these big financials, Charlie, have been like JP Morgan. You want flight to quality. I guess that's where you're going if you're afraid.
Yeah, I mean, up until the second quarter, JP Morgan was a significant underperformer, and it came alive in the second quarter. And that's largely because of a beat and raise, activity in capital markets. So if capital markets don't hold up, then I think by October, JP Morgan's going to be lowering the forecast that they raised in July.
So everything's getting hit. All right. Anything else you want to cover, Jeff?
No, again,
No?
we're seeing just a split market, but I'm liking the price action that I see in some of these post earnings companies. They want to sell them down, but there's actual buyers coming in. They took deck down early. IMAX didn't see the returns that it should have right away, but there's money flowing into it later.
I love
That's
the
a sign of
IMAX.
at least there's
People are taking road
all-
trips. People are taking road trips to go to see that movie on IMAX. That's great.
It's sold out forever. I mean, they're just sitting there, $2 billion of bait. I don't have any idea why someone doesn't buy them, but I'm happy owning the calls in the meantime. So, again, at any market that's working my direction seems smart to me. So, seeing some encouraging action.
All ahead full. All right, Charlie, anything else before we wrap it up?
Nope.
All right. Good luck on your meeting. And Charlie's got a big meeting this afternoon. We will be back here tomorrow. Have a great day, everybody. Follow us on wallstreetbeats.com, and we're out. Thanks, guys.
Thanks, guys. Thanks, Jen.
Thanks, Jen.